Could we please have a low 6-month fix today, old bean? That was a real message sent on a real trading floor, requesting the manipulation of a number worth $400 trillion in financial contracts. The reply took 30 seconds. Done. For you, big boy. I break down Europe's biggest corporate fines every week. Subscribe if you want to understand how billion-euro punishments actually work. Every morning before 11 a.m. Brussels time, a group of bankers at major European institutions logged into a secure platform and typed a number. That number was supposed to represent how much it cost their bank to borrow money from other banks. The European Banking Federation collected all the submissions, trimmed the highest and lowest 15%, averaged the rest, and published a single rate. A EURIBOR, the Euro Interbank offered rate. It determined the interest on mortgages in Spain, student loans in France, small business credit lines in Germany, and over 242 trillion euros worth of derivatives contracts worldwide. In Spain alone, 3.7 million families had variable rate mortgages pegged directly to this number. A 1 basis point manipulation on a €200,000 mortgage costs a family €20 per year. Multiply that across millions of contracts and the sums become staggering. The entire system ran on trust. Banks reported their borrowing costs honestly because the rules said they should. There was no verification mechanism. No auditor checked whether the numbers matched reality. Just an honor system governing the largest financial benchmark in Europe. Like leaving a tip jar at a bank and hoping nobody takes from it instead. Between September 2005 and May 2008, traders at Deutsche Bank, Barclays, Royal Bank of Scotland, Societe Generale, JPMorgan, and Citigroup decided that honor system was more of a suggestion. They discovered something remarkably simple. If you asked the person who submitted your bank's rate to nudge it up or down by a fraction of a percent, and if traders at other banks asked their submitters to do the same thing, you could move the benchmark. A tiny movement. 1 basis point, 2 basis points. Enough to generate millions in profit on derivative positions tied to that rate. They coordinated through Bloomberg terminal chat rooms every single morning. They made requests casually, like asking a colleague to grab coffee. "Could I beg you for a low 3-month EURIBOR fixing today, please?" one trader typed. "I seriously need your help tomorrow on the 1-month fix," wrote another. The submitters complied. "Always happy to help," one replied. They celebrated successful manipulations with promises of champagne. "Come over one day after work and I am opening a bottle of Bollinger," a Barclays trader wrote after getting a favorable fix. "Thanks for the LIBOR." And they kept doing this for almost 3 years without anyone outside their chat rooms noticing. The brokers made it worse. Firms like RP Martin and ICAP acted as middlemen between banks, passing manipulation requests from one trading desk to another. ICAP sent daily prediction emails to bank submitters, nudging them toward rates that benefited their trader clients. Tom Hayes, a derivatives trader at UBS, instructed ICAP insiders to skew these predictions to match his positions. RP Martin brokers earned kickbacks through wash trades. These were fake transactions with no economic purpose whatsoever. 2 offsetting trades that cancelled each other out, generating zero market risk but producing commission payments as rewards for helping rig the rate. The brokers turned a conspiracy between individual traders into a coordinated network spanning 6 banks, 3 brokerage firms, and 3 continents. One trader offered a broker a Mars bar in exchange for moving a rate. "Just give the cash desk a Mars bar and they will set wherever you want," he wrote. A Mars bar for influencing a number that determined mortgage payments for millions of European families. The chat rooms had names: the Cartel, the Mafia, the Bandits Club, the Dream Team. Traders named their illegal coordination rings after criminal organizations and then acted surprised when criminal investigators found them. They typed manipulation requests on Bloomberg terminals, platforms that automatically archived every single message sent through them. A senior Deutsche Bank trader once wrote, "I am begging you, do not forget me. I am on my knees." This was a grown man at one of the world's largest financial institutions, groveling in writing on a monitored platform for someone to rig an interest rate by a fraction of a percent. At Royal Bank of Scotland, a trader marveled at his own scheme. "It's just amazing how LIBOR fixing can make you that much money," he typed to a colleague. At Societe Generale, a submitter described the entire EURIBOR process as a total charade. His colleague replied that they should prepare indemnification agreements in case of prosecution. "You will have to bring us oranges when we are in prison," he joked. Nobody stopped. Nobody reported it. The manipulation continued daily for nearly 3 years. On April 16, 2008, the Wall Street Journal published a front-page article titled, bankers cast doubt on key rate amid crisis. The headline did not accuse anyone of fraud. It simply asked whether LIBOR, the London equivalent of EURIBOR, was still reliable during the financial crisis. That single question unraveled everything. The British Bankers Association warned banks to submit honest rates. Regulators in Washington, London, and Brussels opened parallel investigations. Barclays, facing mounting pressure from the US Commodity Futures Trading Commission, made a calculated decision. They would confess first. On June 27, 2012, Barclays admitted to manipulating both LIBOR and EURIBOR and paid $453 million in fines to American and British regulators. The board believed that being first to cooperate would generate political capital and goodwill. Instead, it generated a political firestorm. Within days, CAO Bob Diamond was summoned before the UK Treasury Select Committee for 3 hours of hostile questioning broadcast live on national television. He resigned on July 3rd. Chairman Marcus Agius resigned. Chief Operating Officer Jerry Del Messier resigned. Barclays' attempt at transparency destroyed its entire senior leadership in less than 2 weeks. But that early confession bought Barclays something invaluable from the European Commission: full immunity under the EU leniency program. Because Barclays told Brussels about the EURIBOR conspiracy first, they avoided a €690 million penalty that would otherwise have applied. Everyone else paid. On December 4, 2013, Competition Commissioner Joaquin Almunia stood at the podium in the Berlaymont building and announced €1.71 billion in fines against 8 financial institutions. Deutsche Bank received the largest single penalty, €725 million. Societe Generale paid €446 million. Royal Bank of Scotland paid €391 million. JPMorgan paid €79 million. Citigroup paid €70 million. Even RP Martin, the brokerage firm, paid $247,000. What is shocking about the LIBOR and EURIBOR scandals, Almunia said at the press conference, is not only the manipulation of benchmarks, but also the collusion between banks who are supposed to be competing with each other. 5 months later, the Commission fined Crédit Agricole, HSBC, and JPMorgan Chase an additional €485 million for refusing to settle. Total EU fines exceeded €2.1 billion. At the time, the largest cartel fine the European Commission had ever imposed. Criminal courts followed the regulators. Tom Hayes, the UBS and Citigroup derivatives trader who orchestrated much of the LIBOR manipulation, was convicted at Southwark Crown Court in August 2015. 8 counts of conspiracy to defraud. 14 years in prison, later reduced to 11 on appeal. "I probably deserve to be sitting here," Hayes told investigators during questioning, "because I made concerted efforts to influence LIBOR." Christian Bitar, Deutsche Bank's star derivatives trader, pleaded guilty and received 5 years and 4 months. Colin Birmingham at Barclays received 5 years. Carlo Palombo at Barclays received 4 years. Philippe Moriousef, tried in absentia, received 8. The traders went to prison, the banks paid fines and moved on. The executives resigned with their pensions and reputations largely intact. Then, on July 23, 2025, the UK Supreme Court unanimously overturned Tom Hayes' conviction. The judges ruled that the trial directions given to the jury were legally inaccurate and unfair. He was deprived of that opportunity by directions which were legally inaccurate and unfair, the court wrote. The first person jailed for rate rigging had spent 6 years in prison under a legal framework the Supreme Court later said was wrongly applied. The European Union responded by passing the benchmarks regulation in 2016. Strict governance requirements for administrators, mandatory transparency in methodology, robust fallback provisions for every financial contract referencing a benchmark. LIBOR itself was dismantled entirely. Most currencies ceased at the end of 2021. US dollar LIBOR ended June 2023. New transaction-based rates replaced the old honor system, SOFR in America, SONIA in Britain, Euro short-term rate in Europe. The Financial Conduct Authority took over administration and placed it under full regulatory supervision. Civil lawsuits continue today. The US class action has produced $781 million in settlements so far. The EURIBOR class action has produced $309 million. Municipalities and pension funds across Europe are still filing claims. The traders who typed those chatroom messages treated EURIBOR like a favor you could ask for and pay back with champagne. The system that replaced it measures actual overnight transactions between banks. It took a scandal worth €2.1 billion in fines to make regulators require that a financial benchmark should reflect something real. Next week, Microsoft bundled one browser with Windows. The European Commission said that single decision was worth €1.7 billion in penalties. Microsoft disagreed. Microsoft lost.